We all want to time the market. And when I'm talking about timing the market, what I mean that we want to buy low and sell at highs. But you and me know very well how difficult it is to time the market. And in this video, I'm going to tell you some simple hacks, 3 ways in particular through which you will be able to time the market using mutual fund route. Hello everyone, I'm Shobhit. I'm a Finbiz growth expert and founder of Finbiz Growth Club. We are an aspiring community of new age mutual fund distributors who are determined to change how India invests. So let's spend some time on understanding what we mean when we talk about timing the market. So as the simple definition goes, timing the market is entering the market or stock market at the right time when the market is low and then sell when the market is high. In other times when we need to buy when everybody is in panic and they are leaving the market, and sell when everybody is ready to buy into the market. So if we need to do that, and it is very difficult task to do because there are so many participants, there are so many angles to play with, it is very difficult to catch the bottom and sell on the highs. But if you want to succeed in this timing game, then mutual fund is going to provide you some of the simple hacks which is going to help you in understanding and timing the market of entry and exit. And this can be done through simple mechanism which mutual fund industry is going to offer, which I am going to discuss with you one by one. So the first is to opt for a systematic investment plan route. Now, what a systematic investment plan or SIP means, where you are going to invest on not recurring basis. It may be monthly, it may be weekly, it may be quarterly. So whenever you are committing to invest on a periodic basis in which the money is going to be deducted from your savings account and being invested in your mutual fund account, that is called systematic investment plan. So how you can time the market? You can time the market through a facility which is given by some of the mutual fund companies, which is called Flex SIP. Now what Flex SIP means? Flex SIP means that you are going to invest more when market is down, and you are going to invest less or the mandated amount when the market is going up. So let me give you a simple example so that it is going to make more sense to you. Now to understand that, we need to understand, suppose we are going to commit that we are going to invest say 5,000 rupees per month for say next 5 months or 5 years time period. So every month on a particular date, this 5,000 is going to be invested. Now in Flex SIP, what is going to happen? Suppose I have committed and the 3 installment of 5,000 rupees has gone into, and market has corrected or market has come down. Now in that case, what is going to happen? My contribution of 5,000 into 3, which is 50,000, the market value of this 15,000 would be less than the money which I have invested. And in that case, what is going to happen? In that case, since the market value of my investment is low, my next installment will be more than the regular 5,000 rupees which I have committed for. This means I am going to buy more units at a cheaper price because the market has come down, and because of that, valuation has also come down. So this is going to work for you, and let me give you a simple example. So if you look at this example, the same 5,000 rupees example, if you take, I have committed, my 3 installment has gone, and of these 3 installment, the market value is 12,339 rupees, and my next installment will be determined. My total commitment would be 5,000 into 4, including the present installment, that is 20,000 rupees. But my last 3 installment which I have paid, which is of 15,000 rupees, of that the market value is 12,339. So the next installment will be 7,661 rupees. Why? Because the last 3 installment market value has come down. So here, since the market has corrected, the value has come down, I am going to contribute more, and that is going to help me in getting more units at a cheaper price. In case market is going up on a regular basis, then what is going to happen? Then the regular amount of 5,000 rupees is going to be invested. And how this is going to be beneficial for the customers? HDFC Mutual Fund, which is offering this facility, it has tested it backward, and they have found that, and let me share their findings with you. They have found that if they are going to be looking at 5 years interval time period of this kind of flex investments, 100% of the time the flex SIP is going to generate better return than the normal SIPs which you are going to do. So this means it is going to make much more sense for you to go for this route where you will be able to generate better returns. You can see the alpha generation which is happening here. So this is a flex SIP which most of the AMCs are offering. So in case you are looking to time the market and want to invest more when the market is going down, then flex SIP can be one route which can fasten the wealth creation journey for you. Now, other way in which you can buy low is through booster SIP. Now, what we mean by booster SIP? We mean by booster SIP is here the amount of investment would be higher when market is low, depending upon some internal parameters which is being developed by ICICI Mutual Fund. So ICICI Mutual Fund has come with the concept of called booster SIP and booster STPs, where they will be allowing to invest more when the market is down so that you can get more units at a cheaper price. So how it is going to work? Let me explain this for you. So in this case, what is happening? First, they are going to create an equity valuation index. It means they have their own internal mechanism through which they are going to find what is the index value depending upon various technical parameters like PE ratio, price to books, and debt market, and so on and so forth. So depending upon that, they are going to come up with some numbers which is called EVI, that is equity valuation index. Now with this, they are going to come up with the multiplier on the base amount. What multiplier means? How much more or less would be invested depending upon the equity valuation index. So if the equity valuation index is low, they are going to invest more. If it is high, they are going to invest less. Okay. So that way it is going to work upon. Now I'm going to give you an example so that it is going to make more sense to you. So just look at this example. If you look at this example, they are saying if the equity valuation index according to their internal parameters is 55, then they are going to invest 10x of the committed SIP amount into the scheme. So it means the market valuation is low, it is looking much more attractive, and because of that, the installment or the investment should be higher. So as you can see, as the equity valuation index goes up, the money which is going to be invested into the targeted scheme will keep on coming down. If equity valuation index is 105, then it is going to be only 0.10 of the committed amount. Now this means what? Suppose you are doing a 5,000 rupees SIP, then you are going to invest at 105 equity valuation index only 500 rupees. So in this way, they are going to be buying more units when the market is low, and they are going to buy less units when the market is high or valuations are high. So unlike flex SIP, where you are going to be buying more when market is down and you are going to buy the regular amount when the market is going up, here in the booster SIP, you are going to be buying less or more depending upon the internal valuation index. Now, how this is going to work out? When you are committing a booster SIP through ICICI Mutual Fund, they are going to do SIP first in their debt fund, and from there they are going to start moving the amount into the targeted scheme. It may be equity scheme, it may be hybrid scheme. So in that way, first they are going to park that investment into debt fund, and then from there you are going to be deploying or the money, or the system is going to deploy the money into the market depending upon the equity valuation. So this is another way through which you will be able to time the market, and it is going to give you little extra alpha generation, besides the regular SIPs which you are going to do. Most importantly, it will be able to help you in timing the market. The third way in which you can time the market is you can play and pause the SIPs. Now what we mean by that? We mean by that is, suppose you have some internal parameter set. You say if Nifty is going to cross say 17,000 rupees, I want to stop or I want to pause my investment for a time till the market is going to come down, cool down to my comfortable valuation. Now, if you look at the Nifty long-term valuation or PE ratios, it is around 22 to 23 in between. So you can set your own internal parameters. You say if the Nifty PE is going to cross here 25, then I'm going to pause my SIPs in the future, and whenever the market corrects or cools down, I'm going to commit more. So in this way also you will be able to time the market. So in systematic investment plans or through SIP route, these are the three ways in which you can buy more when markets are down and able to time the market. Same facilities more or less is applicable in through STP route or systematic transfer plan. Now, how STPs are different from SIPs? In a SIP, the investment is going to come from your bank account into a targeted mutual fund schemes. Whereas in STPs or systematic transfer plan, what is going to happen? First, you are going to park the money into a debt scheme of a mutual fund company, and from there, the money is going to be transferred into the targeted scheme. So here also in the STPs also, you are going to have a facility of the flex STPs, where when the market valuation or the investment valuation is going to come down, the allocation would be more, or transfer of money from debt to equity scheme would be more. So that is a flex STP. Then the booster STP is going to work in the same way as I explained to you, booster SIP, where the money which has been parked into the debt mutual fund scheme, from there more money is going to transfer into equities, so that it can help you in timing the market a little better. The third way to get the valuation or get the benefit of the markets is through a capital appreciation STP. Now in this case, what happens? Let's assume that you are going to park the money into say debt scheme and you want to play conservative. Then you can say every month whatever is the capital appreciation happening in my debt investment, that can be transferred into equity scheme. Or it can work other way around, in which you are going to say that whatever appreciation happens, say 10% appreciation happens in my equity scheme, I want to book the profit and that I can put into my debt scheme. So this way you will be able to get more, or you will be able to book the profit from your investments. Whatever capital appreciation is happening either in debt scheme or equity scheme, accordingly you can transfer to and fro, which is going to help you in either saving the downside or buying more when you have a decent appreciation in your investment. So STPs are also going to be helping you in timing the market effectively, which is going to able to help you in creating your alpha. The third way which is going to be working for you is a facilities called triggers. Now how triggers are going to work? Triggers are going to work in a way you can give a predefined mandate to buy or sell at a particular level. So you can work out triggers in a way that you can say that I have invested in a mutual fund scheme when NAV was say 15 rupees. When the NAV comes down to say 20 rupees, I want to book the profit. So automatically the units will be sold and you are going to receive the money. Or you want to book the stop loss, you say I've invested when the NAV was 15 rupees. If it is going to come down more than 13 rupees, then I want to book my losses. So those kinds of triggers also you can set, so that you are able to book either profit or you will be able to contain the losses. Another way to trigger any action in your investment is through an index level. So you say that if index is going to come down below 15,000, I want to stop my losses, I want to book my losses and I want to come down. Or if you say I've invested today when market is 15,000 Nifty level, and when the market reaches 20,000 Nifty level, I want to book the profit and then again take a decision whether I want to invest further or not. Or you can set a trigger for the capital appreciation. So you say whenever I have a profit of say 20% or 30%, I want to book my profits and I want to come back. So these kinds of triggers also you can set, which will be able to help you in timing the market. So these are some simple hacks which most of us are not aware of, or we are not able to use these insights to time the market well. And why we are going to do all these things? What is the agenda or what we are going to achieve by timing the market? Is to generate alpha besides the regular returns which any investments is going to provide. So if we are able to enter the market in the right time and able to exit the market on the right time, definitely we will be able to generate little more alpha than the regular returns which investments are going to provide. So please explore these options. I am going to leave an Excel sheet in the description which is going to tell you which mutual fund company is offering you which kind of facilities, so that you don't have to do your own homework. You will be able to get all the information as one place, and then you can take an informed call how you would like to time the market. I hope these sessions were useful for you. I hope you got some new insights as how you are going to be developing your portfolio, or in case you are a mutual fund distributor, how you are going to add value to your client. In case you like the content, I would love you guys to hit that subscribe button so that we can grow. Please hit that bell icon so that whenever we have something new to share, you will be first one to know. Thanks for watching. I'm going to see you next time. Good day.